Where's the buyer above me in any of those? Doesn't exist. And then we get a buyer coming in above that price level. Now the possibility is that if there's a buyer willing to pay up here, they may be willing to pay in here. If there's a buyer willing to pay up here, they may be willing to pay in here. Remember, the buyer must come from somewhere. So that directs us to a level. So for example, here, if I see a buyer willing to buy above that price, then they must be willing to buy below that price. Coming into that price there makes a lot of sense. If you're bullish, of course, you've got to be still bullish the market, but it makes a lot of sense to have waited to see that guy showing up. When we see this seller coming in here, we recognize that somebody willing to sell at the top edge is a reasonable proposition for a short sell. Did it happen at any other stage? No, it didn't happen at any other stage, did it? So when we look, for example, here, there was no seller at lower prices, so why would we sell here? When we look here, there's no seller at lower prices. When we look here, there's no seller at lower prices. When we look here, still no seller at lower prices. Or here, still no seller at lower prices on any of those top lines, is there? Nobody. No sellers at lower prices. The seller only comes in from this point here. So when we see a seller at lower prices, there's a chance that any sign of weakness now coming into this top edge could be a selling opportunity. It's really quite straightforward in terms of the technical outcomes that you need to see. We have covered this many times in classroom before. If you're using it, then good stuff. If you're not, then obviously you're still taking gambles that you're able to call top lines and bottom lines without seeing any other people involved in those trades. So when we get another seller at lower prices here, that top edge becomes available. Sell side only, boom. If I was to ask you, is there a buy opportunity here? And you look at it and say, well, where's the buyer at higher prices? 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 And then we get a buyer at higher prices right there. It opens the door to the possibility that any sign of strength off the bottom edges here may be a buying opportunity. And that buying opportunity absolutely rips a cracker to the upside. And from that cracker to the upside, we started to work out where the measured top line was, and we made some nice money on that sell-off here. We've got a buyer at higher prices and a seller at lower prices, allowing you to either sell the highs and or buy the lows. And obviously that led us to this pop to the upside again. We got a seller at lower prices again coming in here. And that led us to that psycho sell right there. That psycho sell made us our money for the afternoon session already. We've already made our money for the day. We've went 89s to 79s. And 89s to 79s is a pretty good S&P trade, if you ask me. That's a $500 S&P trade. And obviously it was an $800 NASDAQ trade. Unbelievable. We went NASDAQ offered at 35 area. We got all the way down to the 85 area, 80s, 90s. And we made ourselves 40 ticks for $800 profit. So again, it's a very, very simple ready reckoner. And again, even here, you can see the storyline. There was a buyer at higher prices. So any signs of strength along that level there would be a reasonable proposition. And then we took out this level here. And there was a buyer at higher prices. So with a buyer at higher prices coming in, where was the buyer from? Well, they must have been this low price here. So that could be a buy opportunity as well. You may say, but is this not a seller at lower prices? Well, it depends what side you're trying to trade from, isn't it? It depends whether you're trying to trade as a buyer or a seller. If you read that as a seller at lower prices, then, well, yeah, it still made a trade. I mean, you would still have been looking at a sell trade up here. And when the market went offered at that stage, yeah, perhaps you managed to get a sell into that trade. Still made money. The point is that it's not necessarily going to even cause you that directional problem. The idea is that it's a story. It's part of an overall story. There's definitely a seller here. Now, is the seller just a stop run? Is the buyer here just a stop run? Well, that's what your value lines are created to help you with. To look at those stop runs and try and figure out whether that is a buy trade for a net long or whether it's a short trade for a net short or whether it's both trades for a I'm not terribly sure type market. I'm not terribly sure if it's bullish or bearish type market. So when we see them, if you still have a problem in fading too early into any particular moves at any particular times, if you still have that problem of when does this become a buy trade, well, it becomes a buy trade when somebody buys it, surprisingly enough. So if you haven't seen any buyer at higher prices coming in, well, it's still a sell. And that meant that you were still able to hold that short sell for the entirety of that move and make yourself a lot of money in the short. The buy finally shows up, boom, time to go. Time to go, time to think about this as a possible long trade scenario. So if you haven't seen that buyer at higher prices, you're still gambling that it might be just exactly where you think it is, but the chances are you're probably going to be wrong. Very high probability that you're going to be wrong unless you start building in some other order flow tools, some other leans, some other ideas, some other value narratives. But on a price action basis, this is what you're looking for. A buyer at higher prices, look for strength at the bottom. A seller at lower prices, look for weakness at the top. Look for that, basically like a Heisman trade entry, if you like.